How arbitrage funds work in a volatile market. Hey everyone, welcome back. In today's video, we are going to discuss arbitrage funds and how they work, especially in a volatile market. With market fluctuations, investors often look for ways to minimize risk and maximize returns. Arbitrage funds are one such option, and they might play a role in managing market volatility. Let's take a closer look. What are arbitrage funds? Arbitrage funds are a type of hybrid mutual fund that aims to take advantage of price differences in the market. These funds work by exploiting discrepancies between the cash and the future market for the same asset. Essentially, they buy an asset in one market when the price is low and sell it in another market where the price is high, making a profit on the difference. This is known as arbitrage. These funds primarily invest in stocks or equity derivatives, using their strategy to generate returns in both rising and falling markets. How arbitrage funds work in a volatile market. In a volatile market, price fluctuations are more frequent, which can create more opportunities for arbitrage. The key advantage of arbitrage funds in such an environment is that they are less reliant on market direction. They aim to generate returns based on price differences. So, even if the overall market is down or uncertain, arbitrage funds can still look for pricing inefficiencies. For example, in a volatile market, the prices of stocks might fluctuate between the cash market and the futures market. Arbitrage funds can buy stocks in the cash market when prices are lower and simultaneously sell them in the futures market when prices are higher. This process allows them to make profits without being affected by the overall market trend. Benefits of arbitrage funds in volatile markets. One of the main benefits of investing in arbitrage funds during market volatility is that they tend to be less risky compared to traditional equity funds. Since these funds aim to profit from market inefficiencies, they don't depend on the direction of the market, but rather on the price discrepancies between different markets. Additionally, they tend to be less correlated with the broader market movements, meaning that they might offer a more stable return during periods of high volatility. Things to keep in mind. While arbitrage funds can be useful in volatile markets, they do come with their own set of risks. For instance, if market conditions change rapidly, the price difference between the cash and futures market may narrow, reducing profit potential. Additionally, these funds might not always deliver returns as expected, particularly if the market is very stable. Conclusion. To sum it up, arbitrage funds can be a useful tool in a volatile market by taking advantage of pricing inefficiencies between the cash and futures markets. They offer a strategy to reduce risk, but like all investments, they carry their own risks. Always ensure that they align with your investment goals and risk tolerance. If you found this video helpful, don't forget to like, comment, and subscribe for more financial guidance. Thanks for watching. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.